What would you rather do? Buy $1 for 50 cents or buy $1 for $1, but it's going to grow at 15% a year? In this video, I'm going to show you how you should think about that question and how it relates to one of my biggest pet peeves about investing, and that is this distinction between value and growth. So what I'm going to do is I have two companies. I call it Company A and Company B. I'm going to use Company A to represent what people think of as like traditional value stocks, and then Company B is going to be our traditional growth stocks, right? Okay, so Company A, the value stock, I'm going to say it's selling at 50 cents, but it's actually worth $1, 100 cents, and it's got a 0% growth rate, okay? So picture this as, I don't know, some companies selling at 50% of liquidation value or net tangible assets or just even working capital, all right? So what is this graph showing us? Okay, so the yearly return is this first column, and what that's saying is, okay, if you bought it for 50 cents and sold it for 100, after how many years, what would your yearly rate of return be, okay? And so just take, for example, like 4 years is 19%. And the way that you would calculate that is you would say that's a 2x, and then in 4 years, what you do is you raise that to the 1 over 4 because it's 4 years. And you see up here, you get a 1.189 or a 19% annualized return, okay? So that's how that math works, right? Then overall return is just going to be your selling price divided by what you bought it for, right? So in this case, it's going to be 100%. All right, and what you can see here with this kind of value stock is that your overall return is fixed at 100%, and it's this flat line here on this graph, but your yearly return drops off every year, and you can see that graph here. You know, the longer you wait, the lesser return you get per year, and that makes sense, right? So obviously, the question you should ask yourself if you're buying $1 but only paying 50 cents is, when do I get to cash in my 50 cents for the $1, okay? Because it makes a huge difference in your overall return. Okay, so next, let's do this growth company, okay? So I'm going to say it's selling right at fair value, price, 100, value 100, and growth, I'm going to put 15%. So really what you can see here is it's pretty opposite, right? Because the yearly return is fixed at 15%, which is the growth rate, and then your overall return is actually going up every single year. All right, so looking at this, which one would you rather own, okay? I think everybody intuitively would want to own Company B, because it's got better overall return. But if you look at the overall return, it has this crossover point here, right at 5 years, okay? And that's just a good rule of thumb too, in case you didn't know. 15% compound interest returns double every 5 years, okay? I'm going on a little bit of a tangent here, but as far as compound interest goes, there's some things that you should memorize, like 15% is a double in 5 years. 7% is a double in 10 years. Those two are easy to remember. 26% is another good one. 26% is a double in 3 years, but also 26% is 10x in 10 years. So that's kind of a neat rule of thumb. And just, look, I'll show you up here in the calculator. 1.26 raised to the 10 is 10x in 10 years, okay? All right, tangents over. Let's talk about this crossover point, okay? Because you may be thinking, okay, look, as long as I sell this value stock, the blue line, before 5 years, assuming it's realized its value, I'm going to do better than the growth stock, or, better than some companies selling at fair value, but that's making a high return on invested capital, okay, to be more precise. But we'll just call it a growth stock for now. And that's what actually really bothers me about this kind of value investing approach, where you're looking for things that are selling, based on balance sheet value. And it's something that I did early on whenever I was learning about investing. Like, I was so excited to find stuff that was selling at, PBs that were less than 50%, or something selling for less than working capital. But I think that there's a few reasons why those are actually traps and that you should avoid them, okay? So let's talk about the first one. The first reason, and the biggest reason in my opinion, is that it's time sensitive, okay? Every year you hold on to something that you're hoping to sell because, it's going to reach its liquidation value or whatever. You're losing returns every year. And what you'll hear people say, and this is probably my least favorite thing about value investing that I hear, okay? It's not real value investing, but they'll say something along the lines of, well, we're waiting for some value catalyst, or what's going to be the trigger for the value to be realized, okay? Something like that. In my opinion, that is equivalent to predicting when other people are going to behave in the market, which is no different than speculation, okay? In a sense, you're really trying to time the market, right? Because you're assuming that the value is going to be realized, in this time span, right? Whenever your yearly return would be higher than if you stuck with, a company that was actually growing. And if you really know the timing of something, if you're really confident about it, then you're better off just doing options anyway. So, and I'm not an options fan, but that's that's what makes them more lucrative, right? Is because you have to get the price and the timing right. And let's compare that to company B, right? Because company B, what's so neat about this like growth stock, or really I'm saying growth stock, I just mean a stock that has a good return on invested capital, or that's growing earnings or buying back shares, a company that's consistently growing their cash flow per share, earnings per share, okay? What's so great about that is that you do not care whenever this value is realized, okay? It can be realized in year 1. It can be realized in year 7. You don't care. You're still going to get a net good return. In this case, it's the same return. It's ironic because it's more of a value investing approach than what people view as value stocks, right? Okay, reason number 2. Reason number 2 is that whenever you sell the value stock, you have to continuously, find another place to put the money. You have to recycle the money because, okay, just because you sold it here, let's say that you sold it in year 3, you got, annualized 26% return. That's awesome. Okay, now you got to find somewhere else to put the money, okay? I think Charlie has some kind of quote. It was an answer at an annual meeting, I think, where he kind of touches on this, saying something along the lines of, the worst part of looking for these stocks is that you have to continuously replenish them. You have to keep on finding new ones. You can't just buy and hold, right? So reason number 1 is counting on market timing. Reason number 2 is this money recycling. And then reason 3 is a little more subtle, but it's this idea that the liquidation value is never actually realized at its full potential. There's a lot of frictional costs associated with that. So what you'll see with these companies where you think, oh, this is awesome at selling at half liquidation value, is that the liquidation value is not really 100. Once it's all said and done, it's going to be more like 80, okay? So that's one example. And just look at your return now. I mean, even if you do it within 4 years, you're still only at a 12% return. I mean, that's good, but still, it's not crazy, right? But company B, the growth stock, also has a really big, question mark as well. And that is, how do you know that the growth is going to continue, okay? 15% growth is a lot. How do you know that it's going to continue for that amount of time? And this is one that I would, preach extreme caution around because, as far as in the value equation, whatever growth rate you put weighs super heavily in valuation, okay? Because it's raised to an exponential, okay? Whatever growth rate you put is raised to the number of years that you're going to compound for. So it really does make a huge difference in valuation. And that's why I would say whatever growth rates you think, you really need to make sure that you take a good margin of safety there. I really try to shy away from ever assuming more than double-digit growth because I really think it can get you into some value traps. Just take any stock that you like, go put a 15% growth rate on them, and go look what the stock should be worth in 15 years, even if they're selling, even if you assume like a PE of 10 or 15, okay, it's going to be crazy. So that's why my favorite company to look for is going to be kind of this combination of both of them, right? I want to find a company that I think is going to grow at double digits, but that is being priced at, let's say, a low single digit or just single digit PE. I'm gonna go back to USA Truck just because that was my largest position and great hit. But what made that one so special is that they were gonna grow at like above 15% for at least the next 5 years, and they were selling at a PE of 3. So like if I just assume that's, let's say I put price 30 and value would be a 10x PE, then this is what that return looks like. And this is what's really been a game changer for me. If I could just sum it up, it would be double-digit growth, single-digit PE, right? But if you got anything from this video, it would be to really be cautious whenever you're looking at these quote-unquote value stocks, okay? And be very careful buying things because of balance sheet value. All right, but that's all I got. Let me know in the comments if you like these type of videos or if you want me just to get back to my single company valuations or maybe even the group ones. Let me know. Y'all know the drill. Like, subscribe. I'll see you next time.